Stocks under a little pressure here, but they're close to even after a dip. Ross Gerber is the president and CEO at Gerber Kawasaki Wealth and Investment Management. Ross, NVIDIA going to come save the day this afternoon?
Well, I certainly hope so. I mean, it's all about expectations, and the expectations were really high, and they've come down a lot as people have gotten pretty concerned about, what are they going to do? What about competition, this and that. But actual numbers, that we're seeing from the CapEx from the big companies looks like, NVIDIA should be okay. And it's just all about what people expect and what they deliver.
When you think about delivery versus expectations, I mean, NVIDIA first got to $130 summer last year. Is it time for us to stop calling this thing overvalued? A lot of people still do, even though it's not hard to normalize these valuations to find something pretty reasonable.
Well, actually, NVIDIA is undervalued if they make their numbers.
Yeah.
So like, it's traded, I've owned NVIDIA for a decade, so it's traded around 40 to 45 times earnings for a long, long time, And so when you apply that to, let's say, $4 in earnings, NVIDIA is a reasonably priced stock. I think the forward PE is like 28. So with the, pole position they have in AI, it's hard to argue that NVIDIA is overvalued.
It's really not expensive compared to even the rest of the market at this point.
Right.
What have you made of some of the selling here over the last week, Ross? I mean, we went from highs and potential breakouts to it was kind of like a nasty fake out, but magnitude-wise, it's not a ton of selling.
Right. It's interesting because the market's sort of at this like apex right now where it felt like it wanted to go higher, like another leg. And then it kind of pulled back, and it's been sitting at the 50-day, and then it kind of broke lower, and it looked like it wanted to rally back today and make some progress. And maybe a lot of this is around NVIDIA too. We'll see if it can change the momentum higher. But the momentum has turned pretty negative for a lot of reasonable issues, including just really bad policy coming out of Washington.
Okay. Do you think that's why the market's getting hit? You think it's reflecting Trump 2.0 disappointment?
Yeah, I mean, it's a little early to, be per se disappointed. It's only been 2 months, but I think, when you have just chaotic policy that, you're increasing taxes through tariffs on the whole world, basically. And then, what we're seeing is a rotation into other markets like China and Europe. And all of a sudden, Europe looks really attractive to us. And we've made a little bit of a rotation recently into foreign stocks, which we have not done in a long, long time. But when you start looking at the way Trump isolates the United States and acts sort of like the global bully, it does make, U.S. equities less attractive, compared to the valuation in other countries. And also the fact that, global trade actually is really profitable. And when you restrict this through tariffs and other, taxation and other policies, which just don't really add up to growth, the market now has to accept that we're going to have higher inflation, higher rates, lower growth, possibly a pretty decent amount of inflation, and then you're restricting immigration, which holds back growth and then makes the cost of labor go up. So all of these policies, when you add it up, is inflationary, slower growth, less profitable for the U.S. companies. And so I'm not really sure the logic here when you're supposed to be the pro-business president.
Bonds are looking pretty strong, though, right now, Ross. It's like we kind of dissolved our inflation fear the last couple of weeks, though. Do you think it's pertinent to worry about slowdown, like the inflation versus growth fear trade-off? Last couple of weeks has looked a little bit more like growth fear, if you ask me.
100%. And you're seeing that in the bond market, because it's certainly the bond rally is more a move to safety and really a fear of much slower growth. Now, I can certainly say that at least where I am here in California, we are not in a recession, by any means. I mean, things are still extremely busy. So, I haven't actually seen the actual public, sort of change its behavior in a way that would be much more negative. But I think the markets are anticipatory, so I think that, when you look forward, that's what we're concerned about. I mean, do we have a set of policies that will ultimately be regressive and then hurt growth? And then, bonds are a pretty good example of way to make money with very low risk. And so we've also made that rotation. Sadly to say, we had to pull a little bit of, off the top of U.S. equities and move some into foreign equities and into fixed income, especially high yield and preferred stocks we like, where I can get over 6% with very little risk.
All right. And how much of that free capital to put to work in bonds has come from the money you took out of Tesla? Are you feeling vindicated yet in the pullback here, Ross?
Well, it's not like a great vindication when you own 250,000 shares still. We were at 100 million. We've lost 25 million. We've been sellers, when the stock was higher. But, as I said, still have a ton of Tesla. So I don't wish negative on Tesla. I would argue the opposite. I love Tesla. The problem is Elon Musk. We all know what the problem is. Everybody can bat around all these other issues, but on the actual surface of the company, you'd think they would be doing well, but nobody wants to buy their cars. People are protesting. And Elon, I think, has become one of the most hated people in the world. So this is not good for selling vehicles,
Yeah. All right. Well, the shares have been getting hit so far in the last couple weeks. All that presidential premium kind of evaporating here. A little bit left in the trade. Well, 288, I guess, November 5th, we got like $30 left of presidential premium in the stock, I guess. Ross, thanks. Appreciate it.